I think it's a really important speech because, the question that we keep asking is what happens after the funds rate gets to neutral? And that ultimately, I think, for the markets is the most important question. And what we heard from Chairman Powell today is that this Fed is not going to be preemptive in terms of taking monetary policy into restrictive territory, lifting the funds rate above the neutral rate, unless there is a tangible reason in terms of an actual inflation overshoot that would justify the move. So, I think that's a really important development. That's something we've been talking about here, about the fact that getting to neutral is one thing. You stay on this gradual path, but once you get to neutral, I think the Fed becomes much more cautious. Even if the economy remains strong, I think the Fed gets much more cautious about continuing to raise interest rates.
There's a gradual path of a herd of elk or moose in a side box next to you. Jim, your takeaway from Chairman Powell in terms of the direction of the market.
Yeah, I'm fascinated by the talk about something having changed in the economy. For a while, I've been thinking that the underestimated factor in the economy is technology. You have massive outlet substitution. You have better than measured increases in product and service quality. And that means that the cap is right on inflation, which is why I think Chair Powell is right to say that he sees no signs of overheating in the U.S. economy. I think they will, and they probably should, make another rate hike in September. But I think if they do one in December, they're getting into the area of potential policy error. I think they're running the risk of tightening too fast and producing an inverted yield curve. And so I would think the odds of a raise in December are going down. So I think the market reaction of Treasury yields going down a bit, the dollar weakening a little bit, is probably rational to that context. But my overlay is that the factor that's underestimated by the economists is the technological change going on in the microeconomy.
Michelle, there's obviously no direct, at least doesn't seem like in this speech, mention of trying to finesse exactly what rate hikes do to the Treasury yield curve, as some other Fed policymakers have addressed directly. But this would seem to kind of give cover to those folks who think, look, we can afford to go slower right here. Look at the message from longer-term Treasury yields, not telling us inflation is necessarily going to hit escape velocity. How does that play into next year, do you think?
Yeah, I think it's actually the same sort of idea as we talk about whether or not you lift rates above neutral. I think that if the Fed needs to keep hiking rates, the consequence, is an inverted curve. If they end up having to raise short-term rates over long-term rates, to do so, to go to that extreme level and put potentially the economy at risk, given the historical relationship, there needs to be a reason. They're not going to take action that would invert the curve preemptively. And I think it's the same sort of message. And I would just add on to what both Steve said and the other guest, in terms of the technology and the advancements, the comparisons to the late 1990s and the role of fiscal policy. This is something that I think economists are underestimating as well. Missing the fact that the stimulus we've gotten from the administration has really been focused on the supply side. It's encouraged businesses to, again, invest in technology and equipment, and that sets the stage for better productivity growth, and that's where you can really see the potential for parallels to the late 1990s.